The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast, hosted in association with Frisby's Bulls and Bears, with me, Dominic Frisby. It is the 4th of January and I'm talking today to Tom Winnifrith. Now, Tom is a very interesting guy. He's a writer and an entrepreneur. He was the founder of tips.com or T1PS.com and is now keen to stress that he has nothing to do with that company. He's the owner of the Real Man Pizza Company. He's thinking about fresh challenges ahead, and he's currently writing an excellent blog and a column at ADVFN, where he also has a share tipping newsletter. Tom is nothing if not energetic and prolific. Letters from the Chestnut Cafe is his latest book. It's based on his blog writing in the summer and autumn of 2012, when he produced over 400,000 words at the rate of up to 9 articles a day. And Letters from the Chestnut Cafe is an anthology of the best bits. There's content covering finance, West Ham Football Club, celebrities, cooking, TV, film, philosophy, politics, cats, and Greece and Albania, where Tom spent most of his summer. Tom, welcome to the show. It's a pleasure to be talking to you. It's long overdue that we're speaking, I must say. Why don't we start off? We had a big correction in gold further to the announcements from the Federal Reserve yesterday. Why don't we start off by talking about gold? You've got a book about gold coming out very soon, I believe. What's your opinion on gold at the moment? Are we in a bear market? Are we stuck in a range between 1530 and 1800? What's your take on gold?
I think, Dominic, I'd start by taking the sort of long-term perspective. Let's go back to 1971 when I was 3 and you were no doubt sort of minus something.
No, I was actually 2.
You were 2? Oh, we're the same age, roughly. Back in 1971, of course, we came off the gold standard. And at that stage, gold was priced at $35 an ounce, which was £14 an ounce. And we all know what it is today. Over the long run, gold has been a phenomenal investment compared to the paper currencies. You know, my dad thinks he's a property genius because by buying and selling a house every sort of 10 years since 1971, he suddenly discovered that, you know, he is a sort of property tycoon. Of course, he's actually pretty clueless on that. He's just surfed the wave of inflation, the destruction in the value of the paper currencies. And I think what we have seen over the past few years is an acceleration of that process. And there may be a temporary pullback now because people feel, okay, America's not falling off a fiscal cliff. They may slow the rate at which they print money. But the fundamental reasons why gold is going up, that our governments across the West run vast deficits, which can only be handled by a destruction, the denuding of the real value of their currency and therefore the real value of their debts, continues unabated. I think, you know, there's a very good piece by Ron Paul, of whom I'm a great admirer, saying, what's this about how we've not fallen off the fiscal cliff? We fell off it a long time ago. America is heading for the stage where I think in 2 or 3 years' time, their debt to GDP ratio will be pretty much where Greece was a couple of years ago, just before the crisis struck. These things are just sort of completely unsustainable. I think, you know, that is the pattern going forward. So I remain a long-term bull of gold.
Very good.
I don't really care what happens on a sort of 1 month or a 2 or 3 month view. Long-term, would you, Dominic, would you rather have your money in gold or in, take your pick, any paper currency? I mean, you know, if the policies which the West was following were successful, then, you know, since Zimbabwe pioneered them, Zimbabwe would be in the G7 by now. I rest my case.
One of the words you used there was unsustainable. That's a word we hear a lot. These policies are unsustainable. But if there's one thing I've learnt, is that the can be kicked down the road for a lot longer than people realise. And, you know, there's a lot of people who operate from the Austrian School of Economics who've rightly pointed out a lot of these flaws. But then as soon as you kind of pin them down on timing, they say, well, we Austrians are never very good at timing. How long can the can be kicked down the road for? How long can we extend and pretend?
It's a very good question, Dom. I mean, I think you see increasingly desperate measures as you find that the road is narrowing and there is a cul-de-sac ahead. People taking increasing gambles. I think, you know, we saw there was a good piece on Zero Hedge a couple of days ago talking about how the only way the Spanish government is able to issue bonds is by getting the pension funds of all Spanish state employees to buy them. There is no other buyer of bonds in the market. And you now have a thing where the pension fund of Spanish state employees is almost entirely invested in Spanish government debt, which can never be repaid, and I suspect where the government won't be able to afford to service it at some stage. Now, that is an increasingly desperate measure, and you see that sort of thing as you get towards end game. At the moment, people appear to be happy to buy US government debt or UK government debt because they say, but these people are too big to fail. It's all very well saying that America may have a Greek-style GDP, debt to GDP ratio in a couple of years. But, you know, Greece is a tin pot little country where the politicians are all crooks and it's too small. It doesn't really matter. America is too big to fail. Well, no, it's not. All great empires in the end go the same way. People might have said that Rome was too big to fail. But if you look at what happened to the value of the silver denarii between the time of Julius Caesar and 200 AD, it lost 95% of its value or 99% of its value before it was eventually scrapped. And that was simply because they made more and more of them with less and less silver content. In the end, there can only be one result. I'm not going to say that it's going to be 2018 or 2020 or 2022 when we reach end game, but we have to at some stage.
Yeah, that, excuse me, my dog's barking in the background. He obviously doesn't like what you're saying. He's a fan of Greece.
Through the radio, he can smell the fact that I'm a cat owner. Maybe that's the problem.
One of the things you said there, it took 200 or 300 years for the denarius to lose its value. I mean, that's, 10 generations? It's a long time.
It did, but, you know, the world progresses. We get a lot more efficient at the way we kill each other. We get a lot more efficient at the way we kill our economies. It's 200 years for the silver denarii to lose 99% of its value. We came off the gold standard 41 years ago. Since then, sterling has lost 99% of its value against gold. The dollar's done marginally better. It's only lost 98.3% of its value against gold. So we've managed in 41 years to do what the Romans took 200 years to do. That's progress for you, Dominic.
It's very good. It's good to see we're refining our skills. By
the way, Dominic, the question would be, how long will it take us to lose another 99% of our value against gold? I think you wrote a piece, will gold hit $10,000? Yes, gold will hit $10,000 for the same reason that it's gone from $35 to just under $1,700. So it is a matter of when. Will it take us 41 years? No, it won't. I think, you know, we're getting a lot better at it. The world is progressing. We're a lot cleverer. We have smarter leaders like Obama and Gordon Brown, David Cameron. They're a lot smarter than we were in the bad old days. So probably only taking 20 years.
Very good. Tom, just hang on one second. I'm going to go and hush the dog up. I think there must be a police car. He howls at police cars, and I think he's very wise in that regard. So I think that's why
we live in the police states. Don't worry.
Just one second. Right, here I am. I'm back. Tom, you write, you tip a lot of shares, and you don't tip them always to go up, you tip them to fall as well. And we had a long conversation on the phone about a month ago in which you outlined why a lot of shares, particularly on AIM, are going to really struggle in the coming year or three, not that they, as if they haven't been struggling for the last year or two. What's your current view on the stock market at the moment? Which sectors do you like? Which sectors don't you like? And from there, we're going to talk about gold stocks in particular.
The stock market is a fascinating place because at one level, we've had a tremendous sort of rally over the past few weeks. And there are people whose views I respect, like Ambrose Evans Pritchard, talking about how 2013 could be a year where stocks and gold, of course, race ahead. And they would do that because the governments across the world are pumping money into the system. They're creating fresh money. And therefore, you will see a nominal increase in the value of assets like stocks and gold. And I do have some sympathy with that view, and that would be the reason to be bullish. But on the other hand, you then say, well, okay, the FTSE is trading on a P of whatever at the moment, and individual stocks, you see a range of individual stocks in large caps as well as mid caps, and they're trading on mid-high teens PEs. Now, if they race ahead, you say, well, is that justified by fundamentals? And I can't see that it really is, because the UK economy and the US economy might grow by 1% this year. I very much doubt the UK economy will grow by 1%, by the way. I think it will do well to grow at all. America might grow by a little bit. But there are very good reasons why there will be no real growth in the economies of Britain and America. Given that, why on earth would you expect corporate earnings to grow by 15 or 20%? If you are Unilever or a company like that, you're selling household goods. Consumers have got no money. They've got too much debt. They are reluctant to spend. We saw that over Christmas. I think it's a pretty ingrained pattern now. So it's very hard to push through price increases. And it's very hard to deliver volume increases. So it's very hard for these companies to deliver much profits growth, particularly in the West, where we have an ingrained culture where everybody demands and expects to get a pay rise each year, whether they have been more productive or not. And therefore, there are very good reasons why profits won't increase by very much for these companies. So in terms of fundamental valuations, I would have big concerns. And indeed, it gets worse because there are a lot of these stocks here who are on 15, 20, 25 times earnings. Some of the new media stocks on 150 times earnings. Well, if the economy is relatively weak, these companies are going to have profits warnings. And when you have a profits warning and your stock is on a high rating, your stock gets an almighty spanking. And therefore, I think it's very, in one way, I can see what Ambrose and other people are saying, but on the other hand, I can see reasons for caution. So I'm sort of in two minds about it. I can see that there are stocks out there which offer great value. You can buy stocks with a significant asset backing and which, for various reasons, do have some visibility of earnings. But there are an awful lot of stocks which don't fit that bill, I would be nervous about owning them.
Yeah, I suppose the net result will be volatility and trading within a range for the broader indices.
Yes, I suspect it will be volatile time. I mean, again, I try to look at sort of long-term investments, so I'm not sort of too concerned about the short-term movements, but I think it is going to be a market where you'll see distinct divergence between some stocks. Some stocks are fundamentally cheap. They do have earnings visibility. And I think, you can make some gains. But I think as a bear on the short tack, there will also be some spectacular opportunities. There are companies out there in the new media world whose business models don't work, and yet they're on ludicrous valuations. And there are also quite a lot of highly rated stocks where you have a great potential for downside. I mean, the rally in recent weeks, and one little area which I look at, which are Chinese stocks listed on NASDAQ, has been quite amazing. You have companies here like Solar and Solar, which if you look at their balance sheet, they haven't got any money. They've got stacks of debt. They don't really have any asset backing. In some cases, they have negative net assets, and they're losing money and they're burning cash. So I would have thought that, the fundamental valuation of this, if you assume that a stock is worth the net present value of future discounted cash flows, is somewhere along the lines of nil. Yet the shares have raced ahead in recent weeks because there's an idea that you may get mergers within the sector. Well, if one company which is fundamentally bust merges with another company that's fundamentally bust, I would suggest that 0 plus 0 equals 0. It doesn't make a much difference to the intrinsic value. And the fundamentals for these stocks remain as abject as ever. Nothing has changed. I just think, there have been some bears who've been caught short and have been squeezed. But the markets don't quite sort of stack up to me at the moment.
Okay. We have to be careful about mentioning specific companies. I think in the case that you just have, we'll be all right. But the powers that be don't like us to be too specific. Now, the model that you've just described could very much apply to gold companies, gold exploration companies, gold development companies who are not yet producing cash. There's a strong argument to say they're actually a liability, not an asset. What's your view on that sector, the pre-production gold companies?
I mean, it is a very dangerous sector to be short of because the shares across the sector have taken an almighty beating. And if sentiment turns, we've seen this with the Chinese solar stocks. It could equally be the same way that as gold moves ahead sharply, sentiment turns. You get a few bids for mid caps, and the odd mid cap buys the odd junior, and suddenly, whoosh, the shares go higher. However, having said that, on AIM, my analysis is that about half of the mining companies have less than a year's cash burn to go. That is, say, unless they raise money in the next year, they are bust. And from what I can see, over in Toronto, it's a pretty similar pattern. I think that investors are increasingly cognizant of the fact that the management of many of these companies have, quite frankly, taken the piss. They have run them as lifestyle enterprises. We see what they pay themselves. What we don't see is what they put through on expenses. I think this is something that AIM has to come to terms with, is the level of expenses of some of these CEOs. They are funding a lifestyle. They fly off to Indaba. They stay in 5-star hotels. They go and get the company credit card out as they go for fantastic meals and then off to the strip bars. And shareholders are paying for this, and they've paid for it. The amount, the return that shareholders have got, forget about the share price, because the share price can be driven by sentiment. But in terms of net new commercial discoveries by gold juniors over the past 2 or 3 years, the record is diabolical. It has been a very bad place to put your money. And I think in some cases I will put this down to bad luck. I'm a charitable sort. That you think you have exciting acreage. It's just round the corner from somewhere where somebody found something great or an existing mine, but it doesn't quite work out. I'll put some of it down to bad luck. But in many cases, what has happened here is frankly just a con on investors. A crummy old asset which produced some grades back in the 1970s for Anglo-American is recycled. A promoter goes and raises some money. The gold price goes up, people get enthusiastic, it's pumped and it's hyped, and they raise more money. But this asset, would never be economic unless gold suddenly goes to $5,000 an ounce and all costs remain the same. But in the enthusiasm of a bull market, people have quite deliberately floated assets which will never go into production in your lifetime or mine, Dominic, and they used it to fund their lifestyle. And there is a whole industry around this of executives, non-executives, nomads, brokers, PRs, etc., and investors have lost out badly. Now, I do question whether investors will stump up over the next 12 months for some of these enterprises. The very reason that central banks are printing money, that the governments are running huge deficits, that they all want inflation, is because consumers and corporates and investors are sitting on their cash or trying to repay debt. And for that reason, I think investors are going to be very reluctant to chuck speculative money at companies which have no proven assets and have a proven liability in a management team who enjoys a great lifestyle. So I think there could be an issue here with these companies going bust. Of course, the way that the stock market always operates is that they won't go bust. They will get down to their last few 100,000, and then they'll be turned into a cash shell, and they'll be reinvented, and they'll become an investment vehicle, or they'll become have some daft new media startup from just down the road where I am in Clerkenwell or Shoreditch injected into them, and the whole merry-go-round will start all over again. But I think there is very, very good reason to say that for the mining juniors, this could be a bleak 12 months. I would go one stage further and say the same applies to oil as well. It has been remarkable that we have been asked to believe over the past year that there have been dozens of companies listed on AIM who are drilling prospects, and we're told there's a 15-20% chance of success and you should risk weight them accordingly. Well, actually, when the drill bit has gone into the ground, we found about 1 in 20 of these things finding commercial prospects. Well, that to me tells you that the chance of success wasn't 20%, it was 5%. And therefore, these stocks were 4 times overvalued. And the fact that they've all come down by 75% implies the market is waking up to that now. But oil, like mining, it's capital intensive. And once you've failed, and shareholders have taken a 75% spanking, it becomes that much harder to raise money to keep the show on the road.
Yeah, I mean, one of the problems, I suppose, that gold mining faces is that, I mean, in a way, it needs to go, I mean, it's already going through it, but it needs, the purge that you've described needs to go on further so that only, the legitimate companies survive, or at least the majority of companies that survive are legitimate. The bad ones need to go. Which it kind of suggests to me that even in the environment of a rising gold price, there's more to go. There's more bear market to come in the miners.
I think it's going to be selective. I mean, if there is, there will be a rising gold price, and
genuine producers will do well.
Genuine producers will do well,
and also those prospect generators. Genuine exploration companies that have shaped themselves in such a way that they can survive a bear market.
Correct. So maybe you're looking at a 2-tier sector. It's going to be the smaller plays, of which there are too many, which will have to reinvent themselves as daft new media startups for our reverse takeover. Maybe that is the case. I mean, that would be a welcome winnowing out of the ranks of companies on AIM. The question, though, is I kind of think we've sort of all seen it before. We've seen the way that the quoted markets in this country in America are designed to create enterprises which will never create value for shareholders. And whether it is the mining sector now or the biotech sector on the USN, unlisted securities market, the precursor of AIM, you see the same patterns happening again and again. There is a whole industry which is designed to raise money for companies and list them. And the industry is all about raising money. It's about the promote. It's not about creating returns for investors. It supports a class of serial director, and it supports a lot of advisors, etc., in the city. Does it create any real wealth for people? I'm not so sure. I feel rather jaded on this. I think there is it's very interesting that when you speak to people like Nigel Ray, who will, like yourself and myself, be speaking at UK Investor Show on April 13th. Nigel has been a stock market operator for a long time, probably longer than you and I have been alive, Dominic. But increasingly, Nigel makes his investments in private companies because he just argues that AIM, the costs of getting a listing, the cost of supporting a listing, the fact that if you're a CEO of an AIM company, you benchmark your pay to other CEOs on AIM companies. This is especially true in the mining sector. And therefore, you're paid a telephone number, however rubbish you are at your job. And then we have the great expenses fiddle, etc. Means that it's very, very hard for shareholders to get a return. By the time you've taken away all of these costs associated with being a PLC, it's a material amount. I mean, if you raise, let us say, £2 million to float an AIM-listed enterprise, by the time you've done the float and the fundraise, you kiss goodbye to 500,000. The costs of running that company on AIM, by the time you've paid AIM-style boardroom wages, advisors' fees, the board have taken the piss on expenses, you probably got, even before the company's actually done anything, before it's done anything at all to create value, it will be incurring $750,000 costs a year. So in 2 years, you're out of money. So why on earth would you invest in that? All you're doing is you're investing to create a way of channeling money to other people. Isn't it far better to put your £2 million into a private company where you can have some control on costs, and the money can actually go to develop a product. And I think people are sort of reaching that conclusion about the lower reaches of AIM. It's just a dreadful investment, and AIM needs to sort this issue out.
Tom, it's been wonderful hearing what you have to say, and you don't pull your punches, and it's great that you do that, and it's great to listen to. We're going to close this interview. As we do so, I want you to just plug two things. Firstly, plug three things. Why don't you plug the Investor Show on April the 13th, which you've already mentioned. Give your book another plug, and also give your blog a plug.
Okay, Dominic, thank you for this. First up is the show. That's on April 13th in London. The speakers include Nigel Ray, Mark Slater, Evil Knievel, the short seller, Dominic Frisby, Nigel Farage, the leader of UKIP.
Oh, fantastic.
He's a very funny man. And the theme is very much investments. There are about 20 speakers there and about 80 companies exhibiting. There'll be 2,500 people. It's being organized by ADVFN and myself. But there's also the overriding theme of the sort of financial and moral bankruptcy of the big state that we live in. And that's something that Nigel Farage and actually Nigel Ray and I think you too, Dominic, feel pretty strongly about.
Yeah.
So you can get details of that event at www.ukinvestorshow.com. Secondly, the book, it's Letters from the Chestnut Tree Cafe. Literary people will know that is where Winston Smith sat waiting to die after he came out of room 101. It's a reference to life in Airstrip 1 in 1984. The theme of my writings over the summer was very much along those lines. It's about the financial bankruptcy of the Western states, both in here and in Greece, not in Albania, by the way, where they have a progressive, low-tax, small-state regime. And that's why their economy is the second fastest growing economy in Europe. But it's what's happening in Greece and Britain. When the government spends too much, it not only bankrupts you financially, but it intrudes on every aspect of your life. And I do find that we live in an increasingly Orwellian world where you get arrested for saying something nasty about someone on Twitter. And the government, the police are very good at that, not so good at helping you if you have your car broken into. So it's from a libertarian perspective, a look at the world we live in today. It's an ebook. It's published by Harriman House, £5. Letters from the Chestnut Tree Cafe. Finally, my blog.
Tom, let me just interrupt you. The cost is £5. It just momentarily cut out then, and it sounded like the cost is £500.
No, 500. Feel free to pay that much if you want, but £5 will get you the book. Finally, my blog. I write for about 10 financial websites now, financial and political websites. Those free to access websites, nearly all of them. I put a link to any article which appears both in the UK and the US on my own blog, tomwinnifrith.com. But as you say, I also write about other things that interest me. So about half the content is non-financial, be it West Ham United. I annoy a lot of people by saying we should sack Fat Sam Allardyce at the end of May and bring in Paolo Di Canio. Whether it's about my cats.
Can I just say, Tom, that is the most ridiculous thing that you've said in this entire interview, that you should sack Allardyce. Look what he's done for the club.
He's had a vast budget. We're going to finish second half of the table, and it's not good enough. You need someone with long-term vision who can inspire the community.
He's taken you up to the Premiership. He's kept you up. He's got you playing respectable football, and you've never been so organised ever.
If you've been at Reading on December the 29th, I haven't seen a West Ham side play that badly. They would have struggled to beat some of the girlies teams in the Olympics this summer. They were awful, and that should have been the first line on Sam Allardyce's sacking letter. I write about my cats. One has 4 legs. One, as of Christmas, has 3 legs. I write about politics. I write about philosophy. I write about cooking. As you say, I do own a restaurant. And I'm very interested in cooking and food. I write about weight loss. I write about ogling birds. I write about whatever I feel like. And it's great that after a few years in which I've been restricted in what I can say, I say whatever I want. And it doesn't really matter whether it's commercial or not. As it happens, people seem to want to read it, but it's fun writing it. So that's tomwinnifrith.com. And that is my free blog.
Excellent. Well, excellent stuff, Tom. And thank you very much for coming on this show. And we'll get you back on in a few months when your gold book's published. The website, once again, is tomwinnifrith.com.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
One of the words you used there was unsustainable. That's a word we hear a lot. These policies are unsustainable. But if there's one thing I've learnt, is that the can be kicked down the road for a lot longer than people realise. And, you know, there's a lot of people who operate from the Austrian School of Economics who've rightly pointed out a lot of these flaws. But then as soon as you kind of pin them down on timing, they say, well, we Austrians are never very good at timing. How long can the can be kicked down the road for? How long can we extend and pretend?
It's a very good question, Dom. I mean, I think you see increasingly desperate measures as you find that the road is narrowing and there is a cul-de-sac ahead. People taking increasing gambles. I think, you know, we saw there was a good piece on Zero Hedge a couple of days ago talking about how the only way the Spanish government is able to issue bonds is by getting the pension funds of all Spanish state employees to buy them. There is no other buyer of bonds in the market. And you now have a thing where the pension fund of Spanish deficits, which can only be handled by a destruction, the denuding of the real value of their currency and therefore the real value of their debts, continues unabated. I think, you know, there's a very good piece by Ron Paul, of whom I'm a great admirer, saying, what's this about how we've not fallen off the fiscal cliff? We fell off it a long time ago. America is heading for the stage where I think in 2 or 3 years' time, their debt to GDP ratio will be pretty much where Greece was a couple of years ago, just before the crisis struck. These things are just sort of completely unsustainable. I think that is the pattern going forward. So I remain a long-term bull of gold.
Very good.
I don't really care what happens on a sort of 1 month or a 2 or 3 month view. Long term, would you, Dominic? Would you rather have your money in gold or in, take your pick, any paper currency? I mean, if the policies which the West was following were successful, then since Zimbabwe pioneered them, Zimbabwe would be in the G7 by now. I rest my case.
It's actually two.
You two are with the same age, roughly. Back in 1971, of course, we came off the gold standard. And at that stage, gold was priced at $35 an ounce, which was £14 an ounce. We all know what it is today. Over the long run, gold has been a phenomenal investment compared to the paper currencies. My dad thinks he's a property genius because by buying and selling a house every sort of 10 years since 1971, he suddenly discovered that he is a sort of property tycoon. Of course, he's actually pretty clueless on that. He's just surfed the wave of inflation, the destruction in the value of the paper currencies. And I think what we have seen over the past few years is an acceleration of that process. And there may be a temporary pullback now because people feel, okay, America's not falling off a fiscal cliff. They may slow the rate at which they print money. But the fundamental reasons why gold is going up, that our governments across the West run vast.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast, hosted in association with Frisby's Bulls and Bears, with me, Dominic Frisby. It is the 4th of January, and I'm talking today to Tom Winnifrith. Now, Tom is a very interesting guy. He's a writer and an entrepreneur. He was the founder of tips.com or t1ps.com and is now keen to stress that he has nothing to do with that company. He's the owner of the Real Man Pizza Company. He's thinking about fresh challenges ahead, and he's currently writing an excellent blog and a column at ADVFN, where he also has a share tipping newsletter. Tom is nothing if not energetic and prolific. Letters from the Chestnut Cafe is his latest book. It's based on his blog writing in the summer and autumn of 2012, when he produced over 400,000 words at the rate of up to 9 articles a day. And Letters from the Chestnut Cafe is an anthology of the best bits. There's content covering finance, West Ham Football Club, celebrities, cooking, TV, film, philosophy, politics, cats, and Greece and Albania, where Tom spent most of his summer. Tom, welcome to the show. It's a pleasure to be talking to you. It's long overdue that we're speaking, I must say. Why don't we start off? We had a big correction in gold further to the announcements from the Federal Reserve yesterday. Why don't we start off by talking about gold? You've got a book about gold coming out very soon, I believe. What's your opinion on gold at the moment? Are we in a bear market? Are we stuck in a range between 1530 and 1800? What's your take on gold?
I think, Dominic, I'd start by taking this long-term perspective. Let's go back to 1971 when I was 3 and you were no doubt sort of minus something. No,